By way of going to the discussion points, I have a couple of points here that I would like to share with you, and that after this, the forum will be open for discussion, and you can you do not need to discuss on this necessarily, but you can also raise questions on the presentations. A couple of issues actually from my observation, and this series of presentations we have today. This product, microinsurance, is a new concept. Toshomi actually mentioned a very good point, that it is relatively easier to get it understood by farmers once you are done with the design work. However, you need a lot of investment to train farmers. You need a lot of work to go to the field and have gatherings in every village to share this information, because the farmers that we are talking about are here and there. You don't find them in the city or in a town where you can just present your product and advertise. That's one clear point that we need to discuss today. The other is, we all know that demand is low, although we have so many experiments going on, a number of pilots going on, and not just in Ethiopia, but everywhere. There is too little that has been scaled up yet. And the challenge, one of the challenges is trust. Remember, insurance is going to the village, you go to the village, you design your product, whatever you do, and you design your product and you go to the field, you ask farmers to pay money. It's not like credit, you go with the money and you give them. It's like going and asking money, actually. So they need to trust you for that. If they don't trust you, they will not give you. So that's a very important issue. The other point is, there are actually informal insurance networks that already exist in this village. One of them is the IFPRI system in Ethiopia, a traditional system that has been established years ago for funeral society, but now developing like an insurance mechanism a little bit. How does your product play out with that? Does it crowd it out, or does it crowd in, or does it encourage it, strengthen it, or weaken it? The other point is, we're not talking about the same farmers. There is a lot of heterogeneity among these farmers. There are small farmers, poorer farmers, larger farmers, really, really poor farmers. If you group them into two, the relatively bigger and wealthier farmers are actually a little bit self-insured. The demand from them is probably low. There is a really, really poorest of the poor who wants this product, but of course, the challenge is they don't have the cash, they are credit constrained. There is also the basis risk Ruth was mentioning in the beginning of her presentation, the residual risk that whatever index you design will not be capturing it. Because of heterogeneity in this village, whatever design you design, it remains to be specific to a very given part of the village. We were working in a 15-kilometer radius, but there were a number of heterogeneities within that 15-kilometer radius, which means that there is this element that is left uninsured that works against the demand. The other is product design is actually very complex. We're talking about a design which requires a lot of actuarial and risk skills. We do not have this everywhere. And I mean, in the developing world. And again, it requires a lot of data. Tashama was mentioning the weather data. It's not just data, but also quality of data. You need to understand, you need to know the profile of the risk there. And you want to design your custom client's risk in a way your product captures the significant proportion of the risk. That is also an important issue. There is also, implementation is not straightforward. You need a lot of capacity development work at the implementation stage. And the last thing that I would like to mention is transferring risk internationally is actually a nightmare. What do I mean by that? You aggregate all these risks in this country and you would like to share it with, you would like to sell it internationally. Because actually risks could be covariant and then the whole country can be wiped out and you are in a disaster situation. To avoid that kind of situation, you need to sell this internationally. But linking these two markets is actually a nightmare. Ruth can tell us about this. She had a lot of discussions with reinsurers. So these are the issues that I would like to mention. And the question now is, are we at the stage of scaling up? What are the challenges for scaling up? And what do our lessons from the pilots tell us about this? We have a number of lessons listed by our presenters and also from the literature. I would like everyone to focus on the issues I have mentioned here. What are the key lessons, basically? And what are the challenges for the scaling up? And how do these lessons help us work out the challenge? And what is the way forward? With this, I would like to open the forum for discussion. Everyone is, yes. Please mention your name and the institution and...
Yeah, my name is Modu Naki.
Who you're asking to?
I am a Leland International Hunger Fellow and I work with CRS in Tanzania. I have about 3 questions, 2 to Ruth and 1 to Tashumi. To Ruth, you mentioned about getting 50, for example, if farmers feel like they have, their yields are lower than they're supposed to, 50 farmers can gather and then go to the insurance company and request payments. So you said also that the company would have to come in and then explain and then try to find out why and then do the payout or not. So I was wondering who's going to do that work? Like who's going to measure, who's going to estimate that, who's going to say if yes, they have lower yields than normal? And then if it's the company itself, would that be biased? The second question is I just want to hear a number on like the insurance. You said somewhere the pessimist says it's expensive. I want to hear a number of like how much does it cost? Just any number in anything. And to Tashome, yeah, I saw in your table there that the number of your customers is actually going down. Aren't you worried? Yeah. Thank you. And why? Yeah, sorry. Or why not?
Yes, please.
Thank you. My name is Nuguse. I'll try to look at whether there is a kind of information asymmetry between the insurance campaign and that of the farmers. As the Berhanu informed us, the insurance companies are selling out, just 2 months before the rainy season, and the contract is only for a short period of time, like 1 year. Now, thanks to the advancement in technology from remote sensing and so forth, the insurance company may get a very good weather forecast, so that if the rain in the future is very good, they are willing to sell out much more information. Do the farmers also could get the same kinds of information? I mean that they couldn't able to access it. Look, the rainfall looks like this in the coming year because based on the weather forecast from remote sensing, something like that. If it is going to be down or something like that, you can afford able to have, so that will also increase the demand for the insurance. If there is information asymmetry where one party have a good information and the other party basically do not have anything, I think the demand is also goes low. Thank you.
Thank you. Here first, Dr. Yeah, what?
Yeah, I'm John from CARE. I'm also from the United States, where a person or a household would have many, many types of insurance. And I would obtain these insurances for two reasons. One, they're required by law, or out of fear. Fear of catastrophic illness or something like that. And no insurance policy do I buy willingly with a smile on my face. So I'm curious how demand gets created in that kind of context. I think probably the same factors would exist here as for me. And for instance, if a household pays in for, say, 2 seasons in a row and doesn't get a payout, do they tend to drop out? Thank you.
Thank you. Thanks. Over there, and then you go back. Here first, and then, oh, okay, you have it, go ahead.
I already have the mic, sorry.
Yeah, go ahead.
My name is Lucy Nyirenda. I'm with the African Risk Capacity. I should say I think there's a lot of interesting research going on in the weather index insurance. I happen to have experienced it when I was working with the government of Malawi. We also tried out pilot index-based insurance, and there were a lot of challenges that were coming up that we've experienced, most of which I can relate to the presentations that have been made. But my question is, Ruth, based on your experiments that you've done, is there a sense of understanding from the farmer's perspective as to what can drive demand for insurance other than just the price and maybe linking it to credit, and them wanting to get the credit, then they are forced to pay an insurance, to buy an insurance policy? Is maybe figuring out what is it that would drive the value proposition. How do we package that information to provide that value proposition to the farmer to see the relevance of having insurance with their farming? Also, one other thing was, when you're working with the farmers, do you get a sense of this perspective of which group of farmers is more interested in getting the insurance? Like, are they food security farmers, or are they semi-commercial farmers? And in this case, at what point does it make more financial sense for the government to come in and support this program? Does the government support the program at the food security level for the individual farmers, or the government takes out that risk, or at the semi-commercial? Do we need to come up with a product that specifically looks at the different categories of the farmers that we're working with? Thank you.